or the end of the trading day. We've got Thato Mashigo, Portfolio Manager at Sanlam Private Wealth, to tell us more. Thato, thanks so much for your time. So not the busiest of days for the markets, just in terms of company news and economic headlines and the like. What kept you busy in today's session?
Good evening, Fifi. I think, as you mentioned, with the rand weakening to about 17.3 at the moment, we are seeing a bit more risk-off trading from especially global fund managers, with capital inflow continuing to shift towards the US and away from emerging markets, Europe and China. At the moment, the US seems to be the only safe haven in town as far as all asset classes are concerned, given the macro situation which you touched on in South Africa, but also the significant likelihood of recession in Europe second half of this year, as well as continuing COVID lockdowns in China. Speaking rather to a rather gloomy global picture, whilst the US remains somewhat of an outlier. We saw the jobs number last week, so momentum is still somewhat positive there, and market participants wanting a bit of a safety play, so to speak, at the moment.
Mm-hmm. So, I mean, this rand weakness that you made reference of, just as a result of the dollar looking like a better place to hide right now, should we expect it to continue, just given the fact that some of those factors you listed, the recession risks and all of that, are not going away anytime soon?
I would say so. We've seen 20 consecutive weeks of inflows into S&P 500 ETFs as well as US mutual funds. And from a valuation perspective, the US market is now back towards its 10-year average in terms of forward PE at 17 times. So perhaps market participants saying, well, it may not be cheap, but it's not as overvalued as it was earlier in the year, in addition to some rather positive fundamentals as far as jobs growth and continuing consumption spend, consumer spend, relative to other regions where the macro picture looks significantly bleaker in the short term. And so market participants particularly favoring sectors that are more defensive, like your staples, healthcare, and utilities. So for those reasons, I think we're likely to continue seeing a bit more favoring or shifting towards an overweight position in the US, underweight Europe definitely. Perhaps a few spots of value in emerging markets, although with our negative GDP print today, perhaps not South Africa, unfortunately.
What did you make of the numbers and the performance of the economy? I mean, just given the fact that we were expected to get a little bit smaller, but in the main, what is this saying to you about investing in South Africa's economy right now?
Perhaps on a more negative side, we haven't grown at more than 3% in over a decade, which speaks to contracting real per capita GDP and consumption, which is a concern. In the short term, I think we are definitely seeing more of a negative outlook going forward. Weakening rand speaks to importing inflation, and we know what's happening with food and energy prices, and that also has a knock-on effect for retailers like ShopRite, which you mentioned earlier. But across the board, the Stats SA numbers showed, I mean, agriculture down 7.7% year on year, mining down 3.5%, and manufacturing down 6% year on year. And that just speaks to the global situation as well. We know the COVID lockdowns have reduced demand in China. That affects our mineral exports. And of course, what's happening with inflation in the Eurozone, that has an impact on agriculture and manufacturing exports as well. So less foreign currency being earned, less demand for the rand weakening, which leads to more imported inflation, as well as more strain on the consumers, not to mention the rising rate cycle, which leads to less credit extension and even more pressure on retail spend. So the outlook is looking quite negative in the short term, and sadly over the long term, the picture is not significantly more positive looking backwards, I should say.
Mm-hmm. You mentioned ShopRite, the biggest loser on the stock exchange today. And despite coming out with results that management said they were very pleased about, why wasn't the market pleased with ShopRite's numbers?
The results were positive on the face of it, but I think perhaps the market is looking more at the outlook as well as the valuation of the business. And market participants might be saying, given the rating of that and how it's performed relative to the sector recently, that despite the results being somewhat positive, it's perhaps not enough. So, I mean, we saw like-for-like sales growth at a group level at 8%, but there was some margin compression. So the trading margin, I think, at 5.9% versus 6.1% last year, a bit of a contraction, and that's obviously due to expense growth. So a few line items, above inflation, if you will, which is unavoidable given the current circumstances that we do find ourselves in. So they mentioned electricity and water expense at 9%, and that is a better performance than ESCOM tariff increases, but it still does speak to, I suppose, somewhat of a tough environment. Africa, they are continuing to consolidate there. They're only in 10 countries now at the moment, but although it's about 20% of sales or so, it's only about 4% of trading profits, so significant margin dilution from that business, and perhaps further rationalization is on the card. Checkers seem to be doing well. I think they're spending more capex to refurbish more stores and compete with Woolies and Pick and Pay. So that is one positive vector, if you will. Liquor shops growth was very positive, but although they mentioned that's due to a rebound from COVID lockdown. And of course, with the acquisition of the Massmart assets, which are still at the competition tribunal stage, which obviously would have to be bedded down, but does change the dynamics somewhat going forward. I mean, the results overall are good, especially given the challenging environment and the strong base that the company was operating off of. But going forward, just looking at where the consumer is and the strain of the consumer, as well as the trend of inflation going forward, and where ShopRite is trading from a valuation perspective, the market perhaps saying that in the near term it may not be the place to play.
So the correction that happened in ShopRite's share price today, with it finishing down over 7%, do you think that it now offers fair value, or does it still have some way to go?
Well, that is quite difficult to say. In the short term, especially, people will be looking at various macro data points and looking at relative trading strategies. How is the consumer going to fare? How are the different retailers positioned? ShopRite, Woolies, Pick and Pay, and what extent will we see trading down from one to the other at the high end? To what extent will we see continued market share gains from the ShopRite? So in the short term, it is somewhat difficult to say. But over the past year, I think the shares up about 20%, although this year to date they're somewhat flat. So concerns around valuation and forward multiples have been relative to perhaps some of the other players in the sector. So going forward, it's difficult to say whether or not one feels that there is value. Definitely that value is unlikely to be extracted in the short term. One will want to see how the Massmart assets are bedded down, what impact that then has on margins and efficiency that can be extracted going forward.
All right, we'll have to wait and see until then. Thato, thanks so much for the insights. Thato Mashigo, Portfolio Manager at Sanlam Private Wealth.